The central bank leaders, both in the US and Europe, were clear in the fall of 2023 that they did not expect to lower interest rates in 2024. If, against expectations, it were to happen, they argued it would be a minor reduction towards the end of 2024. Economists outside the central bank disagreed. They believed that interest rates would be lowered several times in 2024, and to a greater extent than the central banks claimed. Slowly but surely, this has become a consensus among economists. Regardless of whether they work for the central bank or not, several interest rate cuts are anticipated, and these reductions are expected relatively early in the year. Most believe in March or in May. When interest rate cuts have shifted from wishful thinking to a highly probable future, we face the pleasant dilemma of considering how much the interest rate should be lowered. As I have mentioned before on the channel, interest rates will not be lowered due to, at least initially, inflation being too low and the central banks wanted to maintain a low interest rate to stimulate inflation, but rather because the economic situation requires a less contractionary monetary policy. In other words, the weak economic situation needs interest rate cuts. This is particularly the case in Sweden and in Europe. To be optimistic, we can say that the economy is stagnating, meaning it's not growing. However, with continued decline in consumption, higher indebtedness, companies issuing warnings, and increasing unemployment, it is more accurate to say that the economy is declining. A lower interest rate facilitates the indebted households and companies, which can strengthen the economy. Additionally, a low interest rate enables European governments to implement fiscal stimulus by borrowing and spending money on larger public projects at a lower interest rate. For the US, the situation is different, as the economy has fared better through the inflation and interest rate shocks in 2023 compared to Europe. A so-called soft landing, where inflation returns to normal levels simultaneously avoiding a recession, is almost everyone's basic assumption. Therefore, there is not the same demand on the Federal Reserve, the US central bank, to lower interest rates for economic reasons. However, the Federal Reserve needs to consider that, despite not raising interest rates recently, monetary policy continues to become more and more contractionary. The reasoning about the real interest rate is somewhat abstract, but I will try to explain it in an understandable way. Central banks attempt to control the economy through interest rates. What is the interest rate? In essence, it is the reward savers receive for postponing their consumption to a later time. For example, if the interest rate is 3%, it means that someone who saves is postponing their consumption until next year and is rewarded for their patience by being able to consume 3% more next year. When the interest rate rises, it becomes more advantageous to save because you get a larger reward next year. Therefore, many choose to postpone the consumption when the interest rate is high. To rescue an economic downturn, the central bank wants more people to choose to consume this year instead of next year, and therefore they lower the interest rate. But that's not the whole story. Inflation also affects your reward for saving. For example, a low interest rate of 3.75% in Sweden in June 2023 would, in a vacuum, mean that the reward for saving is 3.75% more consumption next year. However, inflation during the same month in Sweden was 9.3%, which means that you can buy less with your money because prices have risen. The real interest rate, the actual reward for saving, is equal to the interest rate minus inflation. In June 2023, it was thus 3.75 minus 9.3, which is equal to minus 5.55%. Therefore, you are punished for saving because you lose 5.5% of your consumption for postponing it until next year. Not a very good deal, I would say. But as inflation has decreased again, the real interest rate has risen. In December 2023, the policy rate was 4% in Sweden, and inflation in December 2023 was 2.3%. Although the policy rate has only increased by 0.25%, the real interest rate has grown to 1.7% because inflation has decreased. Although the policy rate has only increased by 0.25%, the real interest rate has grown to 1.7% because inflation has decreased, which makes the calculation for real interest rates 4 minus 2.3%, which is equal to 1.7%. Thus, monetary policy is much more contractionary now than it was in June 2023, because it is significantly more advantageous to save now than it was back then. Therefore, we understand now that the policy rate needs to be adjusted in relation to inflation. Even if the US does not need to change any interest rates due to a weakening economy, they may still need to adjust the interest rate to achieve the real interest rate they desire. The obvious follow-up question is, of course, what should the real interest rate be? In a situation where inflation approaches 2% in both the US and Europe, greater consideration is given to factors other than how inflation is affected when the real interest rate changes. Thus, as we have discussed earlier, it is logical for European central banks to lower the policy rate to reduce the real interest rate and make it more advantageous for households to consume now rather than later to strengthen the economy. In the case of the US, with a stronger economy, interest rate cuts in this situation are not as logical. Nevertheless, Americans may still need an interest rate cut. Never before has credit card debt in the US been so high, and never before have so many households been unable to pay their monthly debts. In a similar way, the US government has spent a lot of money both during and after the pandemic, leading to record high national debts and unsustainably high monthly interest rate costs. The central bank has a responsibility to ensure financial stability. With a record number of households and a government that has spent more than it should, financial stability is threatened. Arguing for interest rate cuts to ease the interest rate pressure and secure financial stability. In the long run, it is not useful to save the irresponsible households and politicians in the US by lowering the interest rate. Such an assurance by central banks to lower interest rates if borrowing becomes too high provides an incentive for households and politicians to borrow even more. With that said, I believe that the Federal Reserve will be forced to take into account the increasing loan defaults in the US to ensure financial stability. This will lead to interest rate cuts, even though it does not seem logical if we only consider inflation and economic conditions. It is not the right decision in the long run, but yields positive results in the short term. Moreover, after the central bank has endured much criticism after the inflation shock in 2023, the central bank cannot afford to undermine its trust further by risking financial stability with the defense that it is the right thing to do according to their models and forecasts.